Hi, I'm Max Keiser, and this is the Keiser Report. Hey, everybody in Tunisia is rioting because it's part of the global insurrection against banker occupation. Notice that nobody's talking about Islamicist themes. No, these are workers. These are the workers and savers that are rioting against the bankers and speculators. And it's happening in Dublin. It's happening in Athens. It's happening in Iceland. It's happening in the UK. It's happening in Tunis. It's happening all over the world. There's a global insurrection against banker occupation. And this year, we're going to see it heat up even more. Let's get more on this global perspective from Stacy Herbert. Stacy Herbert, hello, hello, hello.
Hi, Max Keiser. I'm in the United States of America.
Fantastic. I heard of it. It's a landmass squashed between Canada and Mexico, as I recall.
Hu Jintao, the president of China, of course, has been here this week in the United States. China's president lays groundwork for Obama talks. So this is President Hu Jintao before he arrived in Washington. And he said the current international currency system is the product of the past. And he highlighted moves to turn the yuan into a global currency. So a lot of people are looking to China for a possible answer to the fiscal and monetary and economic insanity that the West has turned to.
And why not? They've got a good authoritarian government that can simply make rules on the fly and enforce them with the jackboot. This is something that America aspires to. I noticed that somebody in America made the comment, I believe it was Reid, the leader of the Senate majority, who referred to Hu Jintao as a dictator and then quickly had to retract that statement. But hey, he is a dictator, but everyone aspiring to be a dictator, including America, they wish they had a dictator like Hu Jintao to enforce all kinds of price fixing and inflationary policies.
But Max, President Obama allegedly mentioned human rights to Hu Jintao, but then Obama goes and invites Henry Kissinger to the ball for Hu Jintao. So how much of it is just talk? And exactly how much of it is talk with China? Because if you look at the next headline, strong China growth boosted by nearly 1 trillion pounds of loans. So China's economy grew by 10.3% in 2010. But it turns out that, quote, the banks are lending more than twice as much as they were before the financial crisis, and they are also printing new money. Money supply is up 50% from a couple of years ago, according to Alistair Thornton, an economist at IHS Global Insight in Beijing.
Well, Hu Jintao is really the new Ronald Reagan. And in China now, you've got 300 million Chinese yuppies. This is just like the 1980s, except they're Chinese yuppies. They're Chuppies. And they're out there spending money that they don't really have on projects that don't really exist in the hopes of an economic growth that will never materialize.
Well, and if you look at what they're doing with this money supply, how the money supply is growing and why, you'll understand that they're adopting the same exact business model that the U.S. has, which is banking oligarchy. Because according to the article, the banks were keen to lend out this 1 trillion pounds, or over $1.5 trillion. For many of them, their business model depends on the growth of their loan book. The Chinese central bank has set interest rates on deposits at 2.75% and on loans at 5.81%, giving the banks the difference between the two in profit.
Well, that's the way banks should work. That's the very nature of banking right there in a nutshell. But the problem is when banks don't hold any of their capital on reserve. And this is the problem in the global banking system in the U.S., China, and elsewhere. It's okay to engage in classic banking as you just described, but if you have no cash on the books and reserves, if there is a need to step forward with some money and you have none, you have the huge crisis that we saw in 2008, which is going to be repeated in 2011 because these banks still have no money on their books. They're engaged in this huge global Ponzi scheme, and China's at the tip of the spear of the global Ponzi scheme. They're printing like mad. They're building ghost cities that don't exist, and they hope that they're faking it in the hope that they make it. I want to insert right here, Stacy Herbert, a video of me from 1987 when I was working on Wall Street talking about the dangers of yuppies back in 1987. Let's play that tape right here for 20 seconds. Play that tape. This is Max Keiser, 1987, working on Wall Street.
New York broker Max Keiser.
But the idea of a yuppie, money without stopping, that's not the case anymore. And I'm glad to see it. I'm sick of yuppies. No more yuppie chow, no more yuppie magazines, no more yuppie clubs, no more yuppies. Great. That's the only thing we accomplished. If anything, we got rid of the yuppies, and I'm happy about it.
All right, Stacy, yeah, isn't that fantastic?
Nice bow tie, Max. So with this China printing money, Alistair Thornton says they are making automatic profits, referring to the banks, but at some stage you have to pay for all this. And so let's go to the place in the world where they're already at that some stage where you have to pay for all of this. Irish lenders besiege central bank for emergency loans. And other lenders had borrowed 51 billion euros from the Irish Central Bank by the end of December under an obscure program listed in the balance sheet as other assets. Tim Congdon from International Monetary Research says, quote, "This is a horror story. It shows the cataclysmic condition of the Irish banking system. The banks have borrowed 183 billion euros in total, or 110% of Irish GDP. They have burned through all of their capital and a lot of their deposits as well. This is going to end up on the national debt."
Yeah, the key phrase is there, they burned up their capital, as in capital reserves. Exactly what I was just saying. Go back to Iceland, circa 2006, 2007. They loaned out 10 times the country's GDP, and they engaged in stock fraud by lending money to insiders to buy shares in the banks to force the shares higher so that the option would go higher so that the executives could cash out with bigger bonuses, which they then used to buy more shares in the bank. They created a daisy chain of fraud. Same thing in Ireland. That figure of 110, 120% of GDP debt is false. It's 600 to 700% GDP. David McWilliams, who I spoke with in Dublin just a few months ago, told me that the numbers are shockingly higher than what is officially being reported. Ireland is going the way of Iceland, but unlike Iceland, Stacy Herbert, they haven't shut the bad banks down, and they're not pursuing with the hope of prosecuting the financial terrorists. And of course, the Irish people are being asked to suffer austerity measures for something that they had nothing to do with. The wholesale, and the IMF is in there now. Then they're using the collateral of Ireland to stage a hostile raid of that country. They're using Irish assets as collateral to take over the country. The Irish people should join their brothers and sisters in Tunis, in Tunisia, in staging this global revolt against these banking terrorists. The people in Dublin, the people in Tunis have common cause. It's the same revolution. It's one global revolution.
Well, Max, you do mention this hellhole of money printers. World needs $100 trillion more credit, says World Economic Forum. So the world's expected economic growth will have to be supported by an extra $100 trillion by 2020. So they want to double the world's credit supply. Not that we don't already have too much debt outstanding.
But wait a minute, Stacey. Look, this is exactly what is going on in Ireland. The government can't resolve the problems. They can't stand up to the crooked bankers like Sean Fitzpatrick and others. So what they're doing is they're saying, well, we need to monetize, recollateralize, refloat just another few tranches of bonds to try to make this problem go away. Now in Davos, the global banking elite are saying, well, instead of pursuing the corrupt bankers, instead of putting these guys in jail, instead of cutting a few heads off, as they did during the Reign of Terror when a similar revolution was upon the world, they're going to create $100 trillion worth of more bad debt. They're going to take the US dollar, the euro, and all these fiat currencies, roll them into yet another global currency already on the stage with the special drawing rights, $100 trillion worth, and it's all going to be worth exactly 1/100th of what you'll see versus the price of gold today. Gold and silver, as a result of this irresponsibility, will double, triple, quadruple, quintuple in price because nobody is willing to stand up to the crooked bankers. That's the easiest play on gold and silver I can give you. Because nobody stands up to the terrorists, because America and the UK and Israel are in bed with the financial terrorists, gold and silver is a slam dunk. It's a one-way bet.
Well, Max, there are people even in the United States now standing up. This is my final headline here, and it's a tweet. Protesters have entered the MBA servicing conference with bullhorns. Bankers and regulators have fled. Yes, so this is a journalist called John Pryor. He's a journalist for Housing Wire. And he was at the Mortgage Bankers Association conference in Washington, D.C. And as you see from this footage, some protesters from the Sheet Metal Workers Union invaded the conference and freaked out all the bankers there. John Pryor then tweets, "One banker to me, we would have listened to the protesters if they had worn a suit and asked a question without making a scene." So they were in particular protesting against Pulte Homes, which is the biggest home builder in the US, who were able to receive $917 million of their $955 million in profit from a tax carry loss that Barack Obama gave to these home builders. Remember, they were allowed to offset their losses in 2008 and 2009 against all their gains from 2003 through 2000, at the height of the housing bubble. So Pulte Homes was able to collect $917 million in this tax loss carryback, and then laid off 350 workers.
All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
All right, don't go away. Much more coming your way. So if you're on your way to your flight at gate 47B, forget it. The plane took off without you. You might as well just sit where you are and watch the rest of the show. Okay, stay right there. Welcome back to the Keiser Report. Time now to go to New York and talk with Reggie Middleton of the BoomBustBlog.com. That's BoomBustBlog.com. Reggie Middleton, welcome back to the Keiser Report.
Well, thank you, sir. It's good to be back.
Reggie Middleton, global credit needs to double to $200 trillion by the year 2020. So says the World Economic Forum. Your thoughts?
I don't think so. Only if you're going to have an economy that's based upon debt spending, do you need credit to increase to 200 trillion for the economy to grow? Not children, trillion, I'm sorry. It all depends on your viewpoints. I personally don't think that an economy that is based on credit spending and deficit spending is sustainable. Because after you get to 200 trillion, what do you do then?
Yeah, well, it seems as though the Fed is now trying to work into the minutes of various regulatory meetings the idea that they don't need to have any reserves at all going forward, and we're all headed toward a new virtual currency. I'm going to be playing games on Facebook, I assume, like Farmville. I noticed that the Facebook deal at Goldman Sachs completely broke down the domestic side. What happened there, Reggie Middleton?
I couldn't tell you, but if I was a fly on the wall, it looks like the SEC threatened to do their job.
Right, exactly. The SEC threatened to do their job. Apparently, Goldman Sachs was trying to do an end run around the way the law works. You can only have a certain number of investors before you have to come forward with a lot more disclosure. They were openly flaunting that law, and a lot of people now are upset because this whole deal looks like a complete catastrophe. What gives Goldman Sachs the idea that they can simply flaunt the law like this?
They don't have the idea. They're working from precedents. Haven't they done it before? I mean, the last 3 years, Goldman Sachs has been pretty much Goldman Sachs. But I must say, any investors who are upset because they couldn't get into the IPO should count their blessings. They were done a favor. All they had to do is just run the numbers on the IPO, and it was outrageously priced.
Let's talk about those numbers. They're talking about a $50 billion valuation. How do they get to that number, and why is it overvalued?
It's hard to tell how they got to that number because there's no disclosure, at least disclosure to the level of a public company, because Facebook is a private company. But the numbers that was floating around for revenue is about $2 billion. If you use a operating margin that's comparable to Facebook's potential peer group, that means they're pulling in roughly $500,000 in profits. That gives them an outrageous price to earnings. Even if you use a price to earnings growth ratio, Facebook would have to register effectively the entire world, the entire population of computer using individuals to justify that valuation today if you discount it back to the present. That is effectively impossible. It's possible to register everybody, but if I'm not mistaken, you're not allowed to have Facebook accounts in the more populous countries such as China. The number is pie in the sky. Again, it's probable, but if I was an ultra high net worth client of Goldman Sachs, would I put my $2 to $5 million in it? Absolutely not.
Tell us about the state of foreclosure crisis. You write that the banks are now walking away from the foreclosures. What's going on there, Reggie Middleton?
Well, it's starting on the fringes with the lower value properties, but there are cases in Chicago where banks are actually abandoning properties. I warned of this last year, and when I did warn of it, a lot of so-called experts were poo-pooing the idea, basically saying that there is there's a very slim chance of an economic situation where a bank would turn down any recovery. That's assuming that there's a recovery to turn down. There are several situations where the bank simply comes out in the negative if they attempt to go after the property. I don't know if it's that simple, because the bank could potentially still be on the hook with the municipalities for back taxes, fines, etc. But as it is, it's starting on the fringes, and I believe it's going to work its way up towards the core and the mainstream of loans if things continue to go the way they are. And there is absolutely no reason in the world to believe that they're not going to go the way they are, because continue going along this path, because you still have outsized supply as compared to demand. Credit's still tight. Underwriting standards are returning back to a practical perspective because you simply can't use other people's money the way you used to. And we still have yet to come anywhere near equilibrium. What's interesting about this is that the banks are still carrying a significant amount of derivative products based upon housing. And they've, ever since the market rules have been changed, most likely due to regulatory capture, the banks and the S&P have literally skyrocketed throughout 2009. One of the biggest bull market runs in the history of the U.S. markets. The problem is, fundamentally, the problems are not only not gone, but they're actually worse than they were back in 2008.
Yeah, what's interesting, the point you bring up here is that during the lead up to the crisis, the banks were engaged in fraudulent inducement in terms of getting people on board with these mortgages. They committed fraud in packaging these mortgages and securitizing these mortgages and trading them. They committed fraud during the foreclosure process, and they made a ton of money committing all this fraud, billions of dollars in bonuses, $140 billion in years of bonuses this year on Wall Street tied to fraudulent behavior for the most part. And now going forward, you make an interesting point here. All of the derivatives that were the exhaust of all this fraudulent behavior, hundreds of billions, if not several, trillions of dollars worth of derivatives, they're still being traded amongst these banks, amongst themselves, for profits, but they've divorced themselves entirely from the underlying real estate market and mortgage market, which they've then dumped into the lap of the government and the American people. And they said, well, we have nothing to do with those houses, and yet they still trade the derivatives associated with those houses. This is taking fraud from Goldman Sachs, JP Morgan, Wells Fargo, Bank of America, Warren Buffett, to it's got to be a new definition, because it's fraud to the degree of fraud to the fraud. It's a new hyperbolic fraud, Reggie Middleton.
It's called tangible, tradable fraud.
Yes, they've been able to securitize pure fraud and trade pure fraud. And of course, this is the argument you hear all the time. They say we can't bring any regulatory accountability to these firms because otherwise they'd go out of business.
Let's suppose we have 1,000 houses in the suburb of Chicago, which is the story that I'm quoting. I can't remember offhand. But say you have 1,000 houses in the suburb of Chicago, of which one particular bank wrote the mortgages on the majority of them, sold these mortgages off to a securitized trust, and the securitized trust allegedly owns the mortgage. You still have this fraud closure issue of assignment. But let's say they actually do own these mortgages. The houses have dropped in value to close to zero, if not negative, due to encumbrances from the city, taxes, fines, etc. So you have, $300 million worth of mortgages. let's say, take a nominal number. The houses are worth zero. The banks have literally walked away from the houses. The owners have walked away from the houses. How much are those mortgages worth? Best case scenario, they're worth zero. Potentially, they have a negative value because the municipality can potentially go after the banks for it. Yet, they're actually being traded. Is that securitized trust now written down to zero or a negative number? Now, I'm not a lawyer. I don't know what the legal intricacies are, but I can guarantee you very, very, very few of these trusts have been written down to their correct or tradable market value.
Yeah, it's completely, they are worth zero. And they're trading them as if they have 100 cents on the dollar. And it's, as you say, they've taken public pure fraud. The Facebook deal a la Goldman Sachs is taking fraud public. It's not as if there's a barrier to entry. Any 26-year-old college kid can start a social networking site. There's no barriers to entry. As we saw in the movie, it took 10 minutes to create Facebook, and you can do it easily anywhere in the world. It's not like 12-year-old Scotch where you need 12 years to create the product. You can do it in 5 minutes. Now, let's talk about, we were talking last time you were on the show about J.P. Morgan, if memory serves. You made the point, technically, with the derivatives on their books, they also have a book value of zero, and it's also, they just came in with record earnings. But two questions, Reggie Middleton. I don't know if you've tracked this or not. Number one, is the J.P. Morgan earnings a result of trading fraud as a public security, number one? And number two, is J.P. Morgan involved in any of this peekaboo accounting that we saw with Lehman Brothers when they were around, where they simply park liabilities off their balance sheet for a couple of weeks during reporting season?
Well, I'm not an insider. To the best of my knowledge, J.P. Morgan accounting is in line with GAAP, with the GAAP rules. That doesn't necessarily mean that it is accurate. A significant portion of J.P. Morgan's blowout, quote unquote earnings came from the releasing of reserves. And I've always disagreed with the releasing of reserves because the housing market is still in a significant downturn. The economy is not on the upturn. And I don't see a credible reason for the releasing of risk reserves other than to pad earnings. And then there's a matter of the accounting earnings themselves, even the ones that are not attributable to the release of reserves. Let's go back to the foreclosure issue. We have a hypothetical bank, J.P. Michaels. So we don't pick on J.P. Morgan all the time. We have J.P. Michaels, a very large bank, and it has a bunch of loans on houses, of which the owner of those houses has stopped paying the mortgage. The houses go into foreclosure. Okay, they're non-performing. But J.P. Michaels can technically continue to accrue interest on these loans on the books, despite the fact that interest is not accruing because the property is in distress. By the time they do foreclose, they go to foreclosure, J.P. Michaels buys the house back. So they may have to take a loss on the phantom accrued interest, but there's still the phantom principal loan, which they might not have taken a full loss on. And they will when they sell the property. But since properties are not selling, they hold this property in inventory from this point on what looks like potentially in perpetuity. So they don't have to take the full write-down since the property was never sold. So we buy a house for $200,000. We get a $150,000 mortgage on it. We stop paying it. The bank still accrues phantom interest on this $150,000 until they decide to foreclose, which is a year and a half to 2 years after the person stopped paying and they charge the loan off. Or after the person stopped paying, not necessarily, and they don't necessarily charge the loan off. They go to foreclosure a year and a half, some odd later. They buy the property back. They're the only bidder because nobody else wants it, and they hold it in their REO inventory, real estate owner inventory. And they don't have to take the full write-down on this investment until they sell the property, which could be never, or I can't say never, but which is no time soon. Many properties aren't selling. So you have phantom profits on the books of J.P. Michaels, and they're actually accruing and growing. They're getting paid bonuses on it. They're potentially paying dividends on it. Where's this capital coming from? Well, the government has issued trillions of dollars to save the banks. But eventually, capitalism is about ups and downs. It's about, wins and losses, and you have to take a loss. So eventually, you're going to have to come to the truth on this. You're going to have prices mark the market. And when that happens, you're going to have a collapse. And it's guaranteed. Unless the government or whatever entity could blow a bubble big enough to inflate this debacle that I just explained. When that happens, if you catch a bubble, then you have your fiat money inflated. That's if you could catch it. And when that bubble pops, it's going to be worse than the last bubble. It's going to make 2008 look like a bull run.
All right. Well, Reggie Middleton, thanks again for being on the Keiser Report.
You're very welcome. I look to be here again.
All righty, and that's Reggie Middleton. And amongst the insiders in the blogosphere, many consider Reggie's site, Boom Bust Blog, to really be, I'd say, the Reggie Jackson of financial bloggers. He's consistently hitting home runs with his insights. So check out Boom Bust Blog. That's Reggie Middleton. And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Reggie Middleton of Boom Bust Blog. If you want to send me an email, please do so at keiserreport@rttv.ru. Till next time, this is Max Keiser saying bye, y'all.